Good afternoon. Thank you for joining us for today's webinar, where we'll discuss the third quarter results and just kind of continue the ongoing discussion of navigating a challenging loan growth environment and margin environment. My name is Sean O'Brien, President of QwickRate. Just a couple of reminders before we get started. We are in presentation mode, which means hopefully you can hear me. But we can't hear you. So if you have any questions, certainly submit those, and we will take those at the end of the presentation today. Secondly, we will send out an email with a link to today's presentation and a link to the recording. So we'll make those available to you as well. And as always, jumping back into this, I am pleased today to be joined by David Ruffin, who heads up our IntelliCredit division. We are extremely excited to have David and his team working with us. We have certainly enjoyed having him on these quarterly calls. I think he's obviously been a real plus to talk a little bit more about loans and just the credit environment. And certainly we appreciate for many of you who are on the call who adopted our IntelliCredit services, either through an external loan review or a portfolio analyzer product. So we're very excited about the growth in that area of our company. So we'll look forward to David's presentation today. Just a reminder, QwickRate, has evolved into a number of different services beyond the non-brokered CD marketplace. We have QwickAnalytics, which again is kind of the primary data source for our presentation today. And then, as I mentioned, David and the IntelliCredit team is, brought technology to the loan review process, as well as building some cloud-based applications for portfolio analytics and internal loan review solutions. So, very excited about some of the enhancements that we continue to make here at QwickRate, and certainly appreciate your interest and adoption. Certainly with the QwickAnalytics and CECL coming into view, we appreciate all the subscribers who have joined our QwickAnalytics service to utilize our CECL Solver program. Okay, so on to today's talk. We'll talk a little bit about just what we saw in the third quarter call report numbers. Again, I'll kind of give you my not an economist, layman economist view of just kind of what we think the Fed is thinking and continues to think. David will talk. We'll talk about the QCBI numbers and just the bank results. David will take the third quarter credit numbers and give you insight into that. Again, we'll kind of tell you what's the latest here, and then we'll take questions. So we'll keep this thing moving, and again, appreciate your time for joining us today. As we've shown throughout these presentations, if you go back to last year and when the pandemic started, we obviously had the huge drop in GDP. You can see from this Fred chart that we have clearly recovered. But as always with anything, there's never a silver bullet. So as one problem gets solved, in the wake of that, there's always new problems to kind of take their place. Some of the talking points that I think we kind of hear about on a daily basis, is inflation. And then the second one we're hearing about is like, where have the workers gone, right? Those are really the two things that are kind of driving the conversations today. Again, the Fed, their mandate is inflation and employment, and as we've discussed on these quarterly calls, they clearly are leaning more heavily to trying to replace the 4.2 million workers that we're still short from pre-pandemic levels. But I also think it's important, as we start to think about some of these things, just again, just kind of a reminder, are we currently experiencing higher inflation? No question. The Fed says it's transitory. Others clearly say it's different. The Fed is kind of moving the goalpost a little bit about what transitory is, but clearly, what they're suggesting is it's short term, but short term doesn't mean a month or two. Short term in their mind could mean a year or so. So, I think we're gonna live with higher inflation here. For the, till we get closer to replacing those 4.2 million jobs. Once in a while you hear people talk about stagflation from the late 70s and early 80s, or 70s and 80s. Are we approaching or anything like that? I just don't think so. We'll talk a little bit about that. But then, I think we're going to kind of continue to focus on why the job growth up until this month has been kind of sluggish, and maybe where have the workers gone. And then just a final reminder that, I think as we talk about inflation, I think it's always important to remember that technology is inherently deflationary, right? Because if you think about it, it makes people more productive. It also replaces people, right? So it's inherently deflationary. And so I think one of the reasons why, again, if you just think about, kind of a level set, why people are always less worried about inflation than they were, say, early in my lifetime in the 70s and 80s, is because of all the advances with technology. That everything in our society is driven by technology, and that is, again, in and of itself, very deflationary. So again, I think you'll probably, at some point, if you're not already tired of this slide, you're going to see this thing until it becomes an endemic. But I think you have to give the Fed credit. They have been consistent in a number of things, and they have not wavered from this operating premise that the economy is going to depend on the virus. And I think we continue to see that. I think we're clearly moving closer to moving from a pandemic to an endemic. The recent announcement by Pfizer and Merck that they might have a pill that can be conserved as a vaccine. There's just a number of things that we're getting closer to just making this pandemic an endemic, and meaning it'll be a little bit more manageable, and we can to return to something that we can think of as normal. And I think it's helpful. I always think, there's a book a few years ago called The Signal and the Noise, right? That there's separating the signal from the noise. And, and again, I think day to day we're inundated with noise, right? We hear a number of different things from multiple sources. And I think sometimes we have to just try to separate what's fact and what's fiction. And I think one of the ways to do that is to just go back and try to just hone in on something that was it right or was it wrong. And I think with the Fed, and why I continue to believe that they're going to let this economy run hotter, is they really have not strayed from what they have said at the since the beginning of the pandemic. They were very clear back in early 2020 when this all started that they were going to leave interest rates lower for longer. They have. They had said that they didn't anticipate any rate hikes until 2023 or 2024. Well, we're almost to 2022, and they certainly aren't leaning towards any hikes in the first half. Some of it, maybe it's on the table for the second half. And that they said that the monetary policy, the tools that the Fed has, that was not going to be enough to replace the jobs lost at the start of the pandemic, and that they were willing to let inflation run higher than their target until those jobs are recovered. So if we kind of look at that as a scorecard, let's see how they were, how accurate or right they were. And again, one of our talking points is always let's try to be, not try to be overly precise. Let's just try to be directionally correct or accurate. And I think if you look at what the Fed has said, they've been pretty accurate and consistent with their approach. Have interest rates remained low? Yes. They begin to taper bond purchases here in November, but again have said that they really don't see any interest rate hikes until June of 2022 at the earliest, and quite possibly in 2023. So there again, they've been fairly accurate with what they said. They said they needed more than monetary support. We got it. We had the Jobs Act and and the fiscal support that again may be creating new problems, but they got the fiscal support that they were looking for. And that they said that they're going to let inflation run higher than 2%, and they clearly have. They said it's transitory. That's probably still to be determined. But from their point of view, nothing has really changed because again, they are in search of those 4.2 million jobs to be replaced. And so we've shown this the last couple of quarters. As we think about inflation, you can see to the right, inflation's gotten higher. Now this doesn't have all of 2021. On it, but again, it's getting higher, but it's still nothing like we've seen, back in the 80s and 70s. If you look at it since the financial crisis, again, we're not even to points of where we've seen it even in the last 15 years. So while inflation is running higher, there's no question. Let's think about some of the obvious things. We've put a lot of money into the economy. We put a lot of money in people's pockets. That was designed to generate some inflation, so we wouldn't have deflation. I would again say what the Fed has tried to do with what they can control has worked. So while inflation is higher, it's certainly not higher than what we've seen in the last decade or so, and it's not all that surprising, given the amount of stimulus and support that has been thrown at this economy. An old adage was the misery index, which kind of looked at unemployment and CPI, and so in terrible times, particularly like the era of stagflation, this was kind of coined the misery index when you had high inflation and high unemployment. And if you look back to the the mid 70s and early 80s, you can see how high this number got when we had double-digit inflation and double-digit unemployment. You can see that this spiked, again, at the beginning of the pandemic, but now we are well off of those levels. So again, while things aren't great, we've gotten better. And so I think the talk, of stagflation is probably, a bit overblown and probably just not, accurate given what we've seen. And so, with often most all good ideas, I borrowed this one from an economist and advisor I follow, Barry Ritholtz, where he just kind of said, hey, are we headed towards stagflation? And he kind of put together this chart of a number of different indicators, and it just kind of compares what's happening today, versus the 1970s. And as you read through these, right, you really just don't see anything other than maybe a couple of, categories where, there maybe be some similarities. But the majority of these would tell you, again, very little resembles that period of stagflation. So are we in an environment where there's higher inflation? Absolutely. Is it approaching anything near stagflation? It just doesn't really appear to be the case. So, the other point then is, should the Fed begin to tighten interest rates, right? Again, coming out of the last financial crisis, they tightened early. They feel like in hindsight that was a mistake. They cut off inflation too fast, and it slowed the growth of the economy. Raising interest rates will certainly curb inflation, but it will come at the expense of growth. And as we mentioned, until those 4.2 million jobs are replaced, the Fed is comfortable letting inflation run a little bit higher than target. Rising interest rates will certainly, slow growth, and it will eventually cool the stock market if it happens. But as we'll see here in a little bit, the 10-year still isn't moving, based on an economy that's worried about inflation. Already this week, you start to hear of some of the economists at the brokerage houses who are starting to revise downward their expectations for growth in the second half of 2022, even without any interest rate hikes. So again, I think that plays into the Fed's hand, that they believe that growth is going to start to slow on its own in later next year. That immediate interest rate hikes just aren't necessary. I think if if you're the Fed, you're betting on this past month we had over 500,000 new jobs. I think they're hoping as each passing month, as those jobs are created, the supply chain gets a little bit better, that then the economy will be better able to handle interest rates. And I think that's why they have felt like 2023 is really the target. A couple of wild cards to get thrown in here. There's a lot of talk about changes at the top of the Fed. Jerome Powell's term is up here shortly. And so, there's questions on whether he'll be renominated. And then I think the other thing that's starting to get some grounds is, will they actually change the inflation target from 2%? That's a number that's been in place for a number of years, but there's a lot of talk about, would the Fed change that to 2.5% or 3%? Again, it's within their mandate to do that. So again, that could be something that they're just willing to live with a little bit higher inflation for an ongoing period of time. So all those things are things we're going to watch. I believe the Fed is playing from the playbook that they originally drew up. This is a quote from Janet Yellen back in 2016, where she essentially talked about kind of, again, in hindsight, did the Fed move too fast coming out of the financial crisis, and should the economy run, as she put it, a high pressure economy with a lot of demand and a tight labor market. Her feeling was that that could work coming out of situations like this, but I think this is exactly what they have been comfortable kind of running this playbook since the pandemic started. So the other question that we certainly have is, where have all the workers gone? Fiscal support certainly provided cushion. We haven't, that's been a cause for workers not to return. There's obviously been fewer immigrants and our immigration policy has been closed down. New business formations, early retirements, temporary early retirements, aided by the fact that we've seen a lot of, newly created wealth. We've had a rising stock market. Savings rates have been higher up until recently. All the fiscal support, and then there's, $3 trillion of new crypto wealth that really didn't exist, just a few years ago. So all those things I think have led to, workers staying home. This is a Fred chart showing the number of new business started, and you can see that this number has been consistently strong, but since the pandemic has really taken another step up. So a lot of people have simply either left their job or tried to start their own, or maybe retired to start their own. But all of these things are contributing to workers just coming back a little bit slower. The Fed, again, they're looking for those 4.2 million jobs. Here in the last month, we had 531,000 jobs created. So that's very encouraging. I think, again, the hope is that if we can get that kind of run for the next 6 to 8 months, then the economy will have replaced all those jobs pre-pandemic. So that's clearly what the Fed is banking on. And this chart shows you all the employees. So you can see the big dip down from the pandemic. We're still not back to those pre-pandemic levels. We're getting closer, but it's probably going to take another year to get there. And that's what the Fed's willing to wait on. So just as we've shown in the previous past, the Fed is willing to wait on outcomes versus forecasts. In the past, they've always moved early. This has led many people to believe the Fed's going to be behind the ball in terms of inflation, but they clearly are not concerned by that, and they're going to wait to see outcomes before they actually move. And then, as I mentioned, where's the 10-year? So we're not even at levels that we saw earlier in this year. So all the talk about inflation still has not moved the 10-year back to levels that we even saw pre-pandemic, but more importantly, that we even saw earlier this year. So all of those things, again, I think are keeping the lid, on the Fed just, really doing anything, to slow the economy. So here's just some questions we asked last quarter that are still, worth considering. For banks, are we at a period of short-term earnings peak? Where do we go with reserves? Given that CECL's right around the corner, what's going to happen with loan activity? It seems clear there's going to be continued NIM compression. With the 10-year rises and just the lack of supply of new homes, what will mortgage activity look like next year? What's the opportunity cost of staying in cash? And again, any changes in interest rates, what will that mean for our balance sheet? So, again, I think what's ahead, we're fast approaching when this will become an endemic. Certainly the infrastructure plan that passed will create some new jobs and certainly bring some improvements to our country and communities. Home supplies continue to run behind demand, and so I think we'll see continued pressure on housing prices. And then, next year, I think we'll start the tapering process with the Fed. And then I think in the second half of the year, you might start to see some interest rate hikes. I think for banks, as we think about our, where's our loan growth going to come from, I think we have to look to multiple sources. And then I think you start to ask the question, are we, the stimulus, kind of delayed any kind of credit tail or, in some of the liquidity that we've seen in our banks, will that start to run off, or will those deposits stay with us, moving forward? So just some of the things that, again, we kind of continue to think about. So as I get to my numbers here before I pass it to David, we saw another 39 banks leave the industry through consolidation. So now we're at 4,960. You can see the breakdown of those banks. Again, 67% of the banks in our country are under 500 million, but only hold 20% of our assets. Again, asset growth has continued to be strong for banks of all sizes. It's certainly slowed from 2020, but again, everybody's still seeing good growth. But as David will touch on, and we touched on last quarter, this has gotten worse. So the median growth by asset size in the last 12 months is negative for every size demographic that we measure here at QwickAnalytics. And as you can see from the numbers, 55% of the banks in the country experienced negative loan growth over the last 12 months. So certainly continuing to be a concerning statistic for all of us. Deposit growth has stayed strong. 65% of the banks over the last 12 months have continued to see greater than 10% deposit growth. For many of us, that's sitting on our balance sheets, which is part of our problem. But again, I think it's hopefully finding ways to deploy that to alleviate some of these NIM concerns would certainly be welcomed. In spite of all that, we have kind of continued to hold on to good pricing. The median number is still above 5% on loans. Cost of funds continues to come down, but there you can see the NIM, again, compressing to 327 at the median level for all banks. Non-interest income has kind of stayed steady, and we've continued to see improvements in the efficiency ratio. So all in all, again, these are the worst of times. These are the best of times. In a very difficult environment. Congratulations to all of you, because again, you continue to manage it and navigate it as well as you possibly can. That translates into these really strong ROA and core operating earnings numbers. So again, at the median level for all bank sizes, we see really good numbers. Not surprisingly, the larger banks, the $1 to $10 billion banks, continue to see and reap the biggest rewards from all of this. Here again, median ROA and ROE, good across the board. So at this point, I'm going to turn the presentation over to David. And David, I will give you the screen.
Great.
And I can see it.
Great. Thank you very much, Sean. And I want to echo his welcome at the beginning of the webinar to the entire participants today, but also certainly to those particularly IntelliCredit customers. Certainly do appreciate you attending today. I would like to start with kind of the national and regional perspective on credit performance metrics, as again is pretty much our tradition on these quarterly calls. As you can see, the kind of everything again points to rather benign credit. Perhaps in my long career, at least the quantitative aspect of it is about as good as it has ever been. As you can see, kind of bookended between the southwest and the north, in the west, you've got inventory of problem loans or non-performing loans, but again, trending downward since the advent of the pandemic. Charge-offs are inconsequential, particularly since the pandemic onset. And the traditional way of looking at your reserves to loans, again, the West seems to be more highly reserved, the Northeast a little less, but again, the Northeast also shows very limited or very little inventory. An inverse of that is one of my favorite ways of looking at it is, for example, the Western states in this, again, these are all under $10 billion in assets. The Western states are actually covering their acknowledged problems at this point in time over three times. The rest of the regions are pretty well clumped together in about 2.5 to 2 3/4 coverage. Now, I'm a credit guy, so I acknowledge this. It sounds heresy to have a credit or a risk guy say this, but if I were looking at this objectively, what these numbers effectively say is that the Western states perhaps have a little more wiggle room, if you will, a little more flexibility to take a little bit more risk, because your inventory of problems are very low and your reserves are proportionally higher than the rest of the country. And of course, this doesn't even speak to the capital cushion that we've clearly built up significantly since the last financial crisis. But yes, as Sean alluded to, this is the real issue, national loan growth. Yes, there is a increased indication among the community banks of 10 billion and under of even accelerated loan growth deterioration, negative loan growth, if you will. Just to try to be as objective as we can, we did peel away the PPP runoffs, which did show a little bit of sunlight in terms of potential. Another way of looking at that is we potentially for the last 12 months have had 3.8% of organic positive loan growth. That's still very tepid. And as of the end of the third quarter, there was still about a little less than $60 billion of PPP loans that still need to roll off our bank balance sheets. At the end of last quarter, as I recall, that was upwards about 120 billion. So that continues to peel away. But again, one of the reasons I think we're dealing with negative loan growth and the concern about it in our industry, obviously, when you look at it juxtaposed to the thin NIMs that we're constantly having to live with, that's really where we make longer term profitability in banking. And there was even indication, if you look at the Fed data to the right, is that there was negative momentum or some reduced momentum in terms of loan growth, even before we ever thought of or heard of COVID. Regional concentrations, which are traditional that we look at, of course, is in real estate first. Remember, these are guidances, not regulatory mandates. You have on the right chart, which is the broader 300% guidance, you have basically the West with a little more exposure, the Midwest with less. The subset of that to the left, which is the construction and development loans to risk-based capital, you have that kind of bookended by the Southwest states and again, the Midwest. You've got 186 banks in the nation that have exceeded the 100% guidance and 258% on the broader 300% guidance. Again, that's not on its face isn't a particular issue unless it, rather than to just behooves you to justify taking that kind of exposure. In some other ways of looking at exposure or concentrations, I should say, you have multifamily, which is largely a Northeast predominant, not surprisingly given the population centers of the Northeast and the urban environment. And then you have the Southwest in the least. C&I to me is not very meaningful because again of the artificialness of the PPP loan programs. And not unsurprisingly in ag or farm loans, the Midwest significantly outpaces the rest of the nation in that. Now, remember, these are commercial banking data that does not include Farm Credit System information. So what all this continues to be, and I've used this term for successive quarterly presentations on this QwickAnalytics and telecredit update, the word uncertainty, which I thought was really operative, but I now really want to turn that into somewhat of a transition of our challenges, because I do think some of these credit uncertainties are now presenting us with 2022 challenges. Sean alluded to the potential credit tail, which is uncertain at this point, which is the residual, obviously, of an economic shock. So why are these challenges? Well, again, credit metrics are stellar, but if you talk to virtually any banker, they will kind of look at you almost winking, say, yeah, but we kind of know this isn't exactly real, and how much is it enduring? We really are worried about that piece of it. We've absolutely had unprecedented government largesse over such a short period of time, which prevented the Armageddon that we all feared at the advent of COVID. And as importantly, the regulatory relief of 2020, which arguably was unmatched since the Depression times itself, but clearly regulators are back in the saddle. An example of that was I was in a Midwestern state speaking at a trade group not very long ago, and a banker volunteered that a very material credit was forced by a regulator on them to be put into substandard non-accrual because, as he admitted to the larger group, he said we were perceived by the regulator to have abused some of the regulatory respite we were granted for the year 2020. So again, this is what sufficed in 2020 is not sufficing at this particular point in time if you're still liberally using extensions and modifications due to COVID affected loans. And yes, both of these factors have tapered off and probably will continue. We certainly do know that the infrastructure bill will probably have stimulative input into the economy and have a correlation to strengthening certain aspects of the economy, but certainly in terms of the direct government intervention monetarily of the COVID environment and the regulatory respite, those have clearly tapered off. And again, the question begged by all this concern about negative loan growth is, where is natural organic loan growth coming from? We are looking at, if you look at some of these numbers in QwickAnalytics on a state-by-state basis, there's some significant negative loan growth net of PPPs that are clearly showing up in several states. There is also, as I said, some indication that in certain areas, certain markets, that some organic loan growth activity has picked up in the last couple of months. But I think there's some headwinds of market psychology that we almost have to live with for a while, inhibiting a return to normalcy. On the borrower side, there frankly is this sense that, well, I have to change my mindset around actually repaying these loans. If you've been borrowing money liberally through the PPP program for the last year, not knowing that you didn't have to pay it back, it's a mindset change to get back in a normalized environment where you have to actually factor in repaying bank loans. The banks are also not immune from a market psychology. I spoke a couple of weeks ago in Chicago at the Bank Director Conference, and I sensed clearly among panelists, presenters, and even attendees an almost abnormal fear of having any uptick in credit risk that may show that. In other words, I really like the presentation that Sean's given over the quarters, where he shows a lot of trends over the time, and I agree with him. Being directionally accurate is more important than being precise. But metrics are are relative by nature, and where I'm going with that is banks also, I think, have to realize that inevitably we're going to have a little more stress or a little more credit risk. The question for us bankers is, do we panic over even the slightest uptick in that? I think there is resistance to change. Again, it didn't materialize what we all feared. But I do think, in a broader sense than COVID, we're in the greatest churn of our economy since the internet itself. And one of the issues we have to deal with is, as bankers, is, are we positioning ourselves to, in effect, meet new demands, new generational demands that frankly aren't based in baby boomer expectations, in terms of keeping our lending and our banking systems vibrant and attractive to younger generations. This is real because, again, we're showing now data that shows that in this particular subset of C&I lending, that the non-banks, whether they be credit unions, insurance companies, private equity, venture capital funds, wherever the source may be, have now basically gotten to par level with commercial banking in our U.S. economy. And we clearly know the advantages all those non-banks have, largely because they're not anywhere near as regulated as our industry is. I've written a couple of articles in the last month that speak to where we go from here in terms of both growth and risk. I kind of headline this by saying complacency is not our friend, and I do think, unfortunately, with the credit metrics as incredibly benign as they currently are, there is a tendency to become very, very complacent in a sense that, well, what's wrong? If nothing's wrong, don't try to fix it. But I do think we are faced, as alluded to, with a lot of both growth challenges on one end, and also making sure risk doesn't get out of hand, particularly if we use tactics to overcome that growth deficit that we're living with. One of the questions I would leave you with is, where do you stand on these key credit metrics? Remember, we began the presentation today with kind of just a very highly generalized comparison of non-performing loans to your reserve positions. Certainly every regulator that looks at your bank, or even investors for that matter, kind of have that in mind and come in somewhat with a proxy of, are you working through those metrics well, or do you stand reasonably where peers are? That would certainly behoove you to understand where you are on that, because I do think it kind of sets the stage for even more scrutiny if you are a little bit out of bounds on those credit metrics, no matter how good the overall environment is at this point. Again, I think these will be forming a lot of the focus of regulatory scrutiny into 2022 and 2023 as we get through this so-called COVID effect on our portfolio. It is, I think, a legitimate question. Again, maybe sounds heresy coming from a credit guy. Is given your capital and reserve position, are you willing to take any more credit risk to grow loans? Again, I know that just the sense of the conferences I've been at of late is there's almost a afraid of our shadow around being the first to show any kind of credit weakness whatsoever for fear of an overreaction either from investor market or from the regulatory market. But the truth be known is I think when you're dealing with negative loan growth or a very tepid loan growth at best, you have to look at other strategies. And that would certainly include how much tolerance for additional risk and where do you take them. It does behoove you to ask yourself, are we just trying to run the same old playbook and get out of this kind of negative loan growth issue? I do think, and I speak in other groups with a little more detail about are you willing to take different lending opportunity approaches? Again, being a little bit more out of your comfort zone, still doing it in a sound and prudent way, but grasping opportunities to help us as an industry get out of this kind of negative loan growth environment. If you are willing to be more aggressive, I think, of course, you almost concurrently have to be as dedicated, and I do mean as dedicated, to investing in complementary risk protocols as well. For example, better portfolio analytics, more macro information going to bank management and to bank boards on understanding where macro trends of performance are and being able to jump quickly on emerging credit risk as that comes along, and particularly in these subsets that might still be out there bubbling up from a post-COVID affected environment. Now is, I think, the absolute time to make sure loan review is doing its job and being the appropriate gatekeeper in terms of emerging credit risk as possible. And again, we're seeing as a part of the regulatory back in the saddle mindset, if you will, is almost across the board they're suggesting to banks of all sizes, irrespective of your not being prescribed to do it since Dodd-Frank, is that some form of stress testing be considered before the next round of examinations occur at your bank. We at IntelliCredit are very, very dedicated to make sure that our client base gets the benefits of, frankly, taking these three arguably distinct disciplines and making them a little more synchronized, a little more in terms of informing one another, because again, traditionally they're thought of as separate disciplines. I do think that's clearly the wave of risk management for bank portfolios in the future, and we at IntelliCredit are very, very dedicated to this concept. Loan review, in many ways, has been our focal point of what we have tried to take this approach on. In many ways, traditional loan review, as many of you have heard me say many, many times, has been really a model that hasn't changed in 30 or 40 years. We've tried to take the kind of fintech overlay of traditional quality loan review and make it more efficient and far less intrusive to client banks' management teams in the process. We certainly see that as a huge benefit without in any way giving up on the substance and the quality and the collaboration that loan review really must have to be effective. In conclusion, I'm going to speak in a lot more detail, as I've alluded to, on issues of how we seek loan growth and do it well and smartly and with appropriate investment of risk protocols at the next upcoming webinar that we'll be co-sponsoring with Arnie Munson of Holtmeyer and Munson on December 7th at 2 p.m. Eastern. So again, I appreciate, Sean, the ability to share this quarterly presentation with you. Always enjoy it. And again, thank you all. And I will turn this back over to Sean.
Just a reminder, QwickAnalytics covers a number of different things. Again, brought most, top recently by, CECL. We've added call report information for the credit union. So if you want to monitor those, you can see that information as well. Again, we've tried to pride ourselves on QwickRate in building affordable, easy to use solutions. So I'd encourage you, if you haven't taken a look at these, we really like you to take a look. And I think for IntelliCredit, don't take our word for it. We think we've added technology to improve those processes. And so we'd respectfully ask that maybe you give us the opportunity to bid on your next loan review. Just going back to, again, and I apologize for the audio difficulties. The Holtmeyer-Monson and webinar with David, I think is very timely for the banks that have been able to better manage or navigate the contracting, loan growth environment. What we see is that most of them are incorporating or utilizing SBA. So I think the webinar on December 7th is very timely. And again, if it's not something you've investigated, I think it's certainly worth looking into as you move into 2022. The PPP programs allowed many banks to kind of get introduced to the SBA and just the lending opportunities that are available. But I think, again, if we're looking for ways to potentially mitigate the contracting organic loan growth environments many of us face, small business lending might be a great way. Just as a reminder for IntelliCredit, while David and his team do conduct third-party loan reviews utilizing our tool, there also are cloud-based applications, including a portfolio analyzer and smart loan review. So again, we'd encourage you to give David and our team a call to learn more about those. QwickAnalytics, again, certainly the talking point here most recently has been CECL, but there's a number of other tools that are built into our QwickAnalytics platform that we'd encourage you to take a look at. But obviously, right now, given the timing of CECL and the kind of the best practice that most banks are going to run this parallel in 2022, we're certainly seeing a lot of interest, and again, would encourage you and welcome the opportunity to show you what we've built. All right, let me see if there's any questions. Again, I'm really sorry for the audio difficulties. I hate when that happens, so I appreciate everybody staying on and through that. Again, thank you very much for attending. Thank you for working with us at QwickRate, QwickAnalytics, and IntelliCredit. If we can, get a quote for your next loan review, we'd love to schedule a tour to show you either QwickAnalytics, IntelliCredit, or both. We certainly would welcome the opportunity. And if there aren't any additional questions, I think the main questions were around me and not being able to hear me. We'll thank you all very much for your time today. And look forward to hearing you or seeing you on our next presentation. So again, on behalf of David and myself, thank you for your time. Thanks for working with us, and have a great day. Be safe.